My name is Stellah Swakei, a senior associate at Standard Investment Bank, and we are going to talk about the fixed income environment in the month of February. In the month of February 2023, most economic indicators pointed towards a deteriorating environment in the Kenyan economy. To start with, S&P Global, a credit rating agency based in the USA, downgraded Kenya's outlook to negative from stable, and this was mainly because of the increasing risks on the country's debt repayment capabilities given the weakening liquidity position. In addition, the headline PMI, which measures the performance and gives the direction of the private sector business conditions, came in at 46.6, pointing towards a decline in the business conditions. Key to note, a number below 50 points towards a deterioration in the private sector business environment, while a number above 50 points towards an improvement in the business conditions. February's inflation came in at 9.2%, an increase from January's 9%, and this was mainly on account of the high food prices which were recorded in the month of February. On the forex front, the shilling continued to weaken against the US dollar, mainly because of the continued demand for the dollar both domestically and globally. As investors continue to prioritize liquidity needs, short-term government securities remained oversubscribed in the month of February, but long-term papers, that is treasury bonds, remained undersubscribed following the same trend in January as well as 2022. However, as they say, in the midst of chaos, there's also opportunities. Yields on the short term as well as long-term government papers continued to increase in the month of February, thus providing pockets of investments for risk-averse investors as well as investors who are looking to diversify their portfolios. As such, treasury bills and treasury bonds will be a lucrative investment opportunity now that the yields range between 9.7% and 14.2% depending on the tenor. However, it is worth noting that the high interest rate environment has consistently reduced the government's domestic borrowing appetite, seeing that it is still behind the borrowing target. This reflects the government's shift of focus to the external debt space as opposed to the domestic debt space, given that the government reduced its domestic borrowing target and increased the external debt borrowing target. We thus maintain our recommendation that investors should invest in the fixed income market and take advantage of the high rates before the yields start coming down towards the end of the year.